Hello everyone, I'm Christian Frank and welcome to the Expat Expert, where we help future expats like you find their way around the world to live anywhere, work from anywhere, and travel anywhere you want. I'm currently this is a cryptocurrency basics primer course 101, and this is our first live, so we're glad to be part of the YouTube sphere, and we're absolutely excited to be here. If you have any questions during the webinar, feel free to leave a comment or in the chat. And as soon as we're finished, I will go over each question and answer each one in real time. Let's see. Let's go for slides. Excellent. If by any chance you can't hear me, please let me know in the chat as well. Audio seems to be working and slides seems to be working. Let's see. So cryptocurrency has been in the news recently. It's received a lot of coverage. It is an emerging technology as well as an emerging market. And to provide some clarity, I'd like to offer this information as a very basic primer course. In other words, this webinar is, if you don't know anything about crypto, or all you know about crypto is what you've heard on the news, or you think cryptocurrency is a passing fad, this course is exactly for you. Let's start here. All right, about me. My name is Christian Frank. I am an attorney. I've been practicing law since 2007, so it's been 15 years. I started my practice and went to college in Puerto Rico. I am from Puerto Rico, from Western Puerto Rico, a small town called Cabo Rojo. And I practiced law in Puerto Rico for about 10 years. I started off with my own law firm and grew that law firm. After I grew the economy changed in Puerto Rico, so I relocated to Colorado and grew my law firm to 7 figures in about 3 years. I've been practicing nonstop as a litigator. I call this, I've been a relentless defender, litigating for civil rights before mostly federal court and some state courts as well as counsel. I am admitted to practice law in Puerto Rico at a state level, and at a federal level, I am admitted in the United States District Court for Puerto Rico, the United States District Court for Colorado, the United States District Bankruptcy Court in Colorado, and the 10th Circuit Court of Appeals. I currently practice immigration law in the United States. I've transitioned to business law, but the last years I specialized as asylum defense for individuals who come into the United States, fleeing persecution in their home countries, particularly for LGBTQ persecution in Central America. That's what I specialized in. And now I am currently developing plans to become an expat. We call this the exit strategy. And I limit my practice currently to business immigration, tax defense before the IRS, and interstate territorial relations between the United States and Puerto Rico. You see, when I started my practice in Puerto Rico, I specialized in how the laws in the United States apply to a non-incorporated territory in Puerto Rico. And after that, Act 20 and 22, currently known as Act 60, which are Puerto Rico tax benefits, multiple tax benefits. They've received a lot of media coverage recently as well. These are possibly the best ways to minimize your tax exposure as a United States citizen by relocating your business or your personal life to Puerto Rico. I will offer another webinar to these, and I'll link these in the description as well. And my firm currently is developing we call this an exit strategy. An exit strategy is a personalized plan to relocate yourself and or your business overseas for tax benefits, immigration benefits, and investments overseas as well. I provide these services through my firm called USA Defend, and I'll provide the link as well in the description. All right, so what is cryptocurrency? In this webinar, we'll be referring to cryptocurrency and cryptocurrencies as crypto, shorthand for cryptocurrencies. Now, cryptocurrencies, what are they? Why are they in the media so much? Why do some people, some advisors frown upon them? The government criticizes it, and it's pretty much made the news. So since I like to be on the cutting edge of both law and technology, I want to go over these as these emerging markets are being born, as the internet was born 20, 25 years ago, as we know it now. So we are at the bleeding edge of technology, and some of the questions cannot be answered yet because I specialize in the relationship between money and the government and how they interface between each. And the government has a bad habit of taking its time before acting upon or regulating. That's both a good thing and a bad thing, but we'll get to that in a little bit. So crypto is an exchangeable digital asset. What that means, exchangeable first. You can take some of it and convert it into another thing. That is what the currency part pertains to. It's called a currency because it is worth something and can be exchanged for something that is worth something as well. Now, what that value is given to that asset depends on many factors, and we'll get to those in a bit. It is a digital asset. First of all, digital. That means that it exists only online. The transactions are recorded on an online ledger, which is usually public, and this is shared upon all the peers in the network. So everyone who participates in these transactions has access to the information contained in what is called the blockchain. The blockchain is a digital ledger. It's like an Excel spreadsheet, but it's online, and it verifies that each transaction is in chain with each next transaction and grants this validity by corroborating or making sure that those transactions are legit, mainly to prevent the main problem, which is double spending. Crypto is intangible. It cannot be touched. It cannot be perceived by the senses. It exists in the ether of the internet. It exists online only. It is in the cloud and no one owns it. It is shared by everyone, much like the internet is shared by anyone. A few years ago, when you went to a physical store and you bought a physical record, you were owner of the record, a vinyl LP, a cassette, a CD, or a DVD. You bought these items, you bought the media, but the information contained within this media, the music, the sound it makes that you perceive through your senses, wasn't actually yours. It was the author's. And the author had licensed it to a distribution company, a record company. This record you bought at the record store permitted you to listen to the music, to replay a tangible manifestation of the sound, and you could perceive this through the senses. Same thing happened when you bought a movie. You bought the actual cassette, the cassette was yours. You put the cassette inside the VHS and push play on it, and you watched the movie with your senses. Now, these are tangible objects that are manifested through sensory means. Music is vibrations that you perceive them through your ears. A movie is both visual and auditory. A digital-only asset does not exist anywhere. It exists as a common, agreed-upon construct of what this is and who you can trade it with. An MP3 is the best example I can think of because the record, physical media that contained the sound, was then digitized into an MP3, which is an online file, and you perceive this music through your speakers, but it is still sensorial. Whereas digital currency, cryptocurrency, exists online and can only be traded, it can only be converted from physical money to digital money, and from digital money to physical money, or from digital money to stuff. In other words, when it is converted from real stuff to digital assets, it's much like when a document is scanned into a PDF. Is the PDF real? It is a digital file. Does it exist? It exists in multiple places. Your hard drive, your Dropbox, Google Drive, the cloud, the internet, or on a web page. It is there to be accessed. But that PDF is exactly the same PDF all through and through. And as technology grows, that PDF can be granted validity by the government through a digital signature. Cryptocurrency is very much like this. It is exchangeable, but it does not exist physically. Then that is one of the main complaints that most people have. Most people think of money as the little green paper that you fold and put in your pocketbook. But money is no longer like that. Money, if you have a $1 bill, that $1 bill is a theoretical representation of the government's backing, and the government grants that a value. This differs significantly from cryptocurrency because cryptocurrency is a shared common asset. In other words, everyone that has access to the blockchain knows it exists, but does not know who owns it. It assigns a hexadecimal value that becomes your address. Much like your email becomes your address, then your wallet becomes your address, where that cryptocurrency is determined to be owned by that address. And ownership of cryptocurrency is verified by other peers in the network. Other people, other computers, other nodes, these are stops along the way, cross-check that these transactions are really going through and have been transferred from origin to destination. And all this information remains permanently in the blockchain so it can be cross-verified multiple times. This prevents the cryptocurrency from being spent twice. The main problem that particularly the media have adjudicated to cryptocurrency is that it's not anything. Well, it is. It is a perceived common fictional perception. It is an agreed upon construct, exactly like money, because a dollar is worth only as much as another person tells you that they're willing to accept. All right. How do you acquire cryptocurrency? How do you get cryptocurrency? How do you become a crypto investor? There are several ways to acquire cryptocurrency. The easiest is buying. You take your money in your bank account, you transfer it onto an exchange, you create an exchange account. That money is transferred from your $1 bill, perhaps at the bank you deposit it, or you deposit it through an ATM. That money goes into your bank account, and now it's digital currency, but it's digital dollars because the bank is bound by law and by banking regulation to recognize that as a dollar. You transmit that dollar as a dollar through the internet, and then you transfer it to an exchange, for example. The exchange will tell you how much your dollar is worth versus your cryptocurrency, and then with some processing fees, which are usually less than a bank, you convert your dollar into cryptocurrency. There are thousands upon thousands of cryptocurrencies and tokens, and they differ in value. The first commercially available cryptocurrency is called Bitcoin. It's also the most widely adopted, so much so that it is currently the official currency of some governments. And we'll get to that in a bit. You know what? Once you buy cryptocurrency, now you have it, and now you hold it. You can store it forever, or you could put it into circulation. You can also invest with it, and you can do many things. The second way you can acquire cryptocurrency is through gifting. You ask someone for cryptocurrency, they send you cryptocurrency from their wallet to yours, and now it is yours. You did not pay for it, you acquired it as a gift. Much like receiving a car or an inheritance, but not quite exactly as inheriting a bank account. That changes because a gift must be transferred between two living people or living entities. Now, you can acquire cryptocurrency through payment for products or services. Let's suppose you manufacture widgets. You accept US dollars for these widgets. You can accept euros for these widgets, but now you accept Bitcoin. You can accept Ethereum, Ethereum Cash, any sort of cryptocurrency, and you give someone your manufactured widget, and they give you cryptocurrency. You have just traded one thing for another. Another way is you can provide a service, in our case, for example, for our exit strategy, or to pay for my legal services my firm provides. You can pay for our services through cryptocurrency. We have multiple accounts, merchant processing accounts, and wallets where we accept cryptocurrencies as a form of payment for the services we provide. In addition to that, there are other ways to acquire crypto. There's mining, where you have a terminal or a computer that verifies transactions and eases the mathematical burden of the verification of these transactions, and in return, you get a little bit of it, or you charge a little bit for that work. Mining, proof of work, and proof of stake are forms of acquiring cryptocurrency that require some sort of computational labor. This labor is usually traded. This labor usually goes to verify that the transaction did go through. The person who sent the crypto is the person who sent the crypto, and the person who received the crypto is actually the person who's supposed to receive the crypto. For these transactions, some of the crypto gets redistributed along the way. In addition to that, some cryptocurrency networks have recently established what are called fuel charges. Cryptocurrency requires computational power. Computational power consumes energy, and to offset this expense and to offset the carbon footprint, some cryptocurrencies are currently charging a little bit to offset these energy costs. In addition to that, there are multiple websites and exchanges throughout the world that provide transaction services to acquire cryptocurrency, to trade them from one user to another, and to accept them as forms of payment. The most widely known exchanges are called. They're listed on the slide, and these are Coinbase, Binance, Kraken, Gemini, Robinhood, and PayPal. These are multi-billion-dollar companies that have invested a lot of real money into this emerging market. So it doesn't seem like it's going away quickly. And many, many other very large companies, Amazon, Tesla, Google, are currently developing their own cryptocurrency and payment platforms. So if the big guys are looking into it, the little guys such as us should be looking into it as well. Hold on, let me verify. All right, let's go to the next slide. All right, cryptocurrency has several benefits. The first one, and the most widely known one, is that it is decentralized. DeFi, or decentralized finance, is the exchange of these crypto assets without any government or banking oversight. That doesn't mean it's the Wild West out there, although if you read the news or watch the news, it might seem like it's up for grabs and there is no sort of order to any of this. But decentralized means that there is no one owner. There is no monopoly for the ownership and management of these assets. The government is not in on it. The banks are not in on it. There are laws that apply to it in the real world, and we'll get to those. But there is no single owner, no single entity. There is no FDIC to protect it. And that's both a good thing and a bad thing. The good thing is that regulations are liberalized. That means that there are no boundaries and borders to how you can invest crypto assets. There are very few expenses, if any, to manage these. There are no CEOs, no CFOs, no Wall Street banks. There are no corporate minions behind it. The only purpose of crypto is to viabilize the exchange of the transfer of wealth between one part and another. It basically destroys the boundaries that contain real money and that prevent real money from being invested, and it opens up the field to invest money in any new way that can creatively be imagined. So in essence, decentralized finance means that the sky is the limit, and the imagination is it limits on the boundaries of imagination. It is unregulated. It is an unregulated market. That means that the government, as much as the government wants to get its grubby hands on it, it can't. The government wants to make sure that people only spend the crypto in only one way, but they can't control it. The government can't get their hands on it. They can't regulate it. They can tax it. It might create a tax liability, but it can't tell you exactly how to do. Now, this differs from money. Real money, also called fiat currency, is very regulated. It's regulated by laws, regulations, government agencies, international treaties, whereas crypto is not. It might sound like it's completely unregulated, but it does interface with the government somehow. The fact that it is considered stuff, an asset, it's a digital asset, but it is an object. Even if it does not exist physically, it still exists, but it is most definitely not money. The transactions, because there are no banks, no middle people in the middle, there is no sending entity and there is no receiving entity. There's only an exchange when you convert from money to crypto and from crypto to money. The transactional fees are very low. For example, if you transfer funds from the United States to another country, it usually costs an ETF, an electronic transfer fund fee. This fee can vary depending on your banking institution. Your banking institution, if you're lucky, only charges about $15 per transaction, and then sometimes a percentage of the money you want to send. That's based on your contract with your financial institution. Your sending financial institution also has to intertwine with your receiving financial institution. And the receiving bank, may charge, and usually charges, a receiving fee, and it also exchanges the money from what you're sending to what you're receiving. In other words, if you transfer from dollars to euros, the sending bank might charge you just because it's euros. The receiving bank might charge you to convert from dollars to euros, and the banks get fatter and fatter and fatter with these fees. Crypto charges, if the exchange charges for a service while it converts your fiat into crypto, but when you send crypto from one wallet to another crypto wallet, the fees are minuscule. They're usually in the few dollars and cents. The most I've paid for a crypto to crypto wallet transaction is about $1.37. And it works. It simply does work, and it's beautiful because you don't have to fill out forms, right button click, and the money is sent instantly. And it's well verified. And as long as the receiver trusts you as a person or as a business entity, the money's safe. Low transaction fees, the transactions are faster. The most I've seen a transaction take is about a day. Whereas if you wish to cash a check from a United States bank in another bank overseas, there's usually a hold period. For example, where I currently live, which is Costa Rica, if you deposit a check, a United States check, into a Costa Rican bank account, the hold is 30 days. The sending bank makes sure to hold your money for a bit, and then the receiving bank makes sure to hold your money. It takes them a few seconds for the transaction, but they get to hold your money for a longer time to make sure that you really want it. That is inconvenient. That is very inconvenient, because if you really need the money, you're not going to get it for about a month. So when you send crypto from one wallet to the other, the money is immediately available. It's like an ATM transaction, but faster and without a bank in the middle. What can crypto be used for? Crypto can be easily converted into real money, also known as fiat currency. Real money is backed by a government or a government agency. For example, the US dollar is backed by the US government. The US government regulates the amount of dollars that are out in circulation. It emits more dollars, and it increases interest rates and tax rates to reduce the amount of money in circulation. This controls inflation, which is the exchange value of that money between a sender and a receiver of money and the government itself. Crypto can be used to exchange for money, real money, fiat currency, and then it could also be used to buy stuff like real estate, vehicles, and pay for services. Another benefit of crypto is it cannot be frozen, it cannot be forfeited, and it cannot be confiscated. The government cannot lay its hands involuntarily on crypto unless the address holder voluntarily divulges or gives away the information to access these funds. In other words, they can't take it from you unless you let them. Whereas your bank account can be frozen by the bank for any reason, perceived transaction, a past due payment on any of the banking account for any reason. Whereas if you put your money under your mattress or inside of a shoebox, the government can knock at your door, bust the door open, and grab that shoebox. If the government tries to get your crypto, they can't without your password or your recovery key. That means that it is absolutely, positively secured from other parties getting their hands on it. Now, why is that important? Well, the government sometimes has a right to keep your money and sometimes it doesn't. Sometimes the government is right, but oftentimes the government is wrong when it forfeits something. And a great example of this is how the Canadian government has attempted to forfeit crypto donations for the most recent truckers' manifestation in Canada against COVID regulations. Now, this money was frozen, allegedly, by the Canadian government, but what the government really did is freeze the transactions between the wallet and the exchanges to convert these into Canadian dollars. But the actual currency in digital crypto accounts remains there unless it is voluntarily divulged by the owner of the wallet. Let's see. Cryptocurrency has also been accepted as official currency in some governments. For example, El Salvador, which has an emerging economy, a very fruitful one, has currently regulated to accept digital currency, to accept Bitcoin, which is a type of cryptocurrency, as an official government currency. This is very important. First of all, it means a government is trusting the platform enough to accept these payments. Secondly, it means that any government debt can be extinguished with a cryptocurrency. In other words, the Salvadorian fiat currency was one way to extinguish government debts, and now Bitcoin is another way. So they're liberalizing the market to viabilize transactions in the country. El Salvador's fiat currency, in exchange to other currencies, didn't have the same backing, whereas perhaps Bitcoin has now. And Bitcoin has a huge backing because a lot of people have traded fiat currency for cryptocurrency. That is called a market cap, And the more people put money into it, the more backing it has. And the more backing it has, the more solid it is, and the less it fluctuates. And finally, crypto is like money in the fact that it can be easily transmitted and exchanged. It is a common agreed upon fictional construct, which also means that if I'm willing to take it and you're willing to give it, we can assign value that we wish to it, and it can be easily converted. But it's not money. Because it's not money, money rules don't apply exactly to it. There are no accounts, there are no checks, there are no wire transfers. These do not exist because these other agreed upon constructs were created by the banking industry, because instead of having to carry a wheelbarrow full of gold coins, now the gold coins are contained in a little piece of paper, which the little piece of paper is agreed upon by you and your bank that it's worth as much. And as long as everyone agrees on an agreed upon construct, the construct works. Now, crypto is not immune to risks and to problems. The first one, which was originally a benefit, but it's also a detriment, is that there is no government or banking regulation. That means that there is no third larger party that we have delegated upon democratically as the government. And in their eternal sapience, there is no backing there is no secretaries, there is no thousands of published papers that are kept upon in a central repository called legislation. And it exists outside of the boundaries of governments and countries and nations. That means that because it only exists online, the agreed upon construct is there just as long as it is used by other users online as well. And since it is unregulated, it opens the field up to do pretty much anything you want without any government backing. In other words, if a cryptocurrency is created and a lot of people put money into it, and they do so without doing due diligence or without checking out who else is putting money and how this crypto was born, that means that it can go away instantly. The same way banks can file for bankruptcy and banks can close and keep all your money. The same way 401ks can be lost and squandered. The same way pensions can one day be closed out because more money was borrowed by the pension than they actually have money for. And the same way municipalities use pension funds to cover for their own fees, well, crypto can go away instantly. Agreed upon constructs can go away as quickly as they were invented. Another risk of crypto is that it's taxed as capital gains, not revenue. Revenue or income can only be acquired through business practices. That means that income is money that's coming in. And since crypto is not money, it is stuff. How much the stuff is worth and how much the stuff is bought for and sold for, the difference between what you buy it for and what you sell it for is considered capital gains. And capital gains are taxed differently than actual revenue or income. Another problem with crypto is that it can be used to fund illegal activities, such as buying weapons and drugs, and it can be used to fund prostitutions. It could be used to fund terrorism, exactly like cash. US dollars have funded terrible things for a very long time, but the media doesn't pick up on that because it's already happened and it continues to happen. It's easier to say that the new kid on the block is a bully, whereas the old bully is still a bully. So yeah, it can be used for a lot of bad stuff. But crypto can be used for a lot of good stuff as well. For example, microloans, individuals and businesses that don't have a great credit rating. Someone or a business that needs a second chance, but their FICO score is just terrible, and they have absolutely no shot of going to a bank and saying, hi, I have this great business idea. I just came up with this invention. I need funding for it. And all financial institutions are going to give you the cold shoulder because you're a risk for them. If you crowdsource through a crypto or through a decentralized finance platform, you can acquire funding for your business and have your business skyrocket without having to go through the traditional hoops and red tape that applying for a loan entails. Another risk of crypto is that it is highly volatile and it fluctuates easily. That means that because it is unregulated, it depends on the invisible hand of economics. Supply and demand must meet in the middle. How much someone or some people want something and how much of there is it, they have to meet someplace in the middle. And this means that if there are no takers, you're stuck with it. And if everyone wants it, it's worth a lot more. And like stocks are regulated in the United States by several, particularly a government entity called the Securities Exchange Commission. Securities Exchange Commission makes sure that whoever trades stocks, buys stocks, holds stocks, issues stocks, and all these companies that go public, they have to abide by these rules. Whereas crypto has no regulation. Because it has no regulation, the price of the exchange rate between your US dollar and the crypto can change instantly. So that means that your money can grow very quickly. It can exponentially grow, but you can also lose everything from one day to the other. Another problem with crypto is that it's an emerging technology. Oh, I skipped the one before. Crypto has a bad reputation. It's made the news recently. It's received a lot of bad press, mostly out of ignorance. When something's new, it's usually criticized. When CDs came out, everyone who loved vinyl records and who loved cassette said they were too expensive. And when you converted an LP to a CD, you lost some of the warmth of the music. Then, after CDs came out and everyone had a CD, MP3 players came out. And now you converted your crystal clear, uncrackable CD into a digital file that lived in your hard drive, and you lost some of the music quality before that. And then MP3s got better. And then streaming services came along. And now most of your music is probably digital anyway. You're not the owner. You're leasing Spotify or Apple Music to be able to listen to it once in a while. And if you stop paying for it, the music and the right to use this service is no longer there. Crypto has more or less the same reputation. Since it's new kid on the block, it's easy to make fun of the new kid on the block. But like PayPal, like many other new concepts, electric cars, and other emerging technologies, streaming-only movies, these are slowly but surely being adopted by the general public. And I don't think, as cutting-edge technologists, you see, I've been online since '93, and I saw the internet grow from purely text to what we know now, and this type of distribution platform where I can consume a large bandwidth and be able to conduct transactions online instantly. This technology grew from a bad reputation. The US Postal Service hated email, and it considered creating email addresses for all US Postal Service customers. That never came into fruition, and now the Postal Service looks like it's going the way of the dinosaur at the rate it's going. But technology changes, and with these changes, we need to adopt these. And that doesn't always make good press. It's an emerging technology and market That means that we don't know all the answers. We don't have all the answers. The government doesn't know. I don't know the common perception of other users in the crypto sphere, don't know as well. This was just recently, well, it was invented a few years ago because money was invented a very long time ago. But crypto was invented and adopted just a few years ago. Bitcoin came into fruition in 2009. That means that it's been less than 20 years, and we've gone from a green piece of paper is worth $1 to these electronic dollars are worth more dollars and we can do whatever we want with them. And adopting new ideas takes time. For example, when Toyota came out with a Prius, no one wanted to buy it. No one trusted a hybrid car. It was half electric. What happened when your battery conked out? How would you replace it? No one knew at the time. We had the idea, but we didn't know how the execution was going to go. And emerging markets and technologies are like this. Right now, there are many good ideas and many bad ideas around, and only time will tell which ones work and which ones do not. By the way, I am still waiting for that flying car, but I have seen AI self-driven cars in Phoenix, and that's pretty cool. And I really want self-driving cars to take off, and I will most likely pay for those in crypto. Another problem with crypto is that it's not accepted everywhere. If you have one Bitcoin, you have to find someone else who's willing to accept that Bitcoin or portions of it to provide whatever you want for products or services. If you want to buy real estate in another country and they only take their local currency, well, you have an issue because that one thing you want to buy is only worth certain forms of currency, and crypto may not be one of them. Thankfully, many more services, countries, and products are being offered for crypto. And as the public adopts these and puts this asset into circulation, it'll be shared by whomever wishes to be on the bandwagon. Like MP3s, they might be played everywhere, including cars and on airplanes. And finally, the biggest risk for crypto is that governments want it and banks hate it. Governments want it because they can't get their grubby hands on it. They can't take it away from you. They can't forfeit it. And anything the government can't take away from you forcefully, they want to make it illegal because we've delegated democratically to the government the decision-making for what's good and what's bad. The good part is that governments, democratic governments, can be democratically changed, and every voter is responsible for the regulations in their own current country or wherever they live or conduct business. And banks hate it because they can't hold on to it. They can't make money off it. They can't charge you interest, and banks only have one interest in mind, and that's making money for their stockholders. Whatever is detrimental for a bank stockholder is detrimental for the bank, and the consumer is who usually pays the price. Whenever you deposit money to a bank, you're lending the bank your money, and they're charging you to hold on for that money. To hold on to that money. Whenever you use a convenient payment service to swipe your transaction, they're charging the business owner transaction fees for having your loaned money transferred to them, and they probably loaned their money to the bank as well and have bank accounts as well, which are usually cost some banking fees each month, or have a minimum balance to make sure that you give the bank enough money for the bank to be happy with your money. And whenever you transfer that money to another bank holder, well, if it's in your bank, you're going to be charged a fee. If it's to another bank, you're going to be charged even more fee. And charging fees is a way for banks to make money. And however banks don't make money, banks don't like. And that's why banks are funding bad press against crypto. Because since they can't make money off it, because they're the old kids on the block, they're making fun of the new kid on the block. Okay. Crypto, and how is it taxed? At least in the United States. I'm going to limit my brief description of how crypto is taxed in the United States because I am licensed to practice in the United States and I conduct all of my business, most of my business, in the United States. The IRS has determined that crypto is not money. That means that when you acquire crypto, you're trading stuff for stuff. And the rules of stuff vary from the rules of money. The IRS published IRS Notice 2014-21, 2014-16. This is a bulletin that the IRS published on what the rules for crypto are and how they're going to be interpreted by the IRS. You see, the IRS said that crypto is property, not currency. In other words, when you change money into crypto, you're buying crypto. You're not exchanging it. There is no fiat. There is no A and B immediately. There is, I have money, I use money to buy stuff. I am now owner of stuff. My ownership is registered in the blockchain. It is peer verified by other nodes on the network. And the IRS, if you divulge this to the IRS, then the IRS knows that now you're the happy owner of digital stuff. Now, when you tax stuff, it's different than when you tax revenue. When your dollar bill comes in through the door and rings the bell on your cash register, that is income. Fiat through the door is taxed at one rate, whereas purchasing stuff and then when you sell it, it's taxed another way. So capital gains applies to when stuff is transferred. When it is acquired, you adjudicate, you determine how much it's worth. And when you sell it, you determine what it's worth at the time of sale. And the difference, the profit between each one, is taxed at what's called a capital gains. Now, if you sell it for less than it's worth, then you lost it. And you can offset that loss towards your net profit eventually in your taxes. Now, if you purchase cryptocurrency, you don't have to report it, at least until recent regulations change, and all this is currently up in the air. So as soon as this webinar is broadcast, the rules might change immediately. But when it is sold, it'll be determined at what you sold it for, and that'll be taxed at a different rate. Now, capital gains is usually taxed at a higher rate than income tax because income tax is always taxed and can be offset by expenses. Operating expenses minus income is usually profit. And then this profit is taxed by the government based on other IRS regulations. The capital gains tax in the United States is between 15 and 20%, whereas the income tax is bracketed between 10 and 37% for federal income tax. In addition to that, there's state corporate tax, federal corporate taxes, municipal taxes, sales taxes, and use taxes. All that may apply particularly to income, but none of these apply to capital gains because since crypto is nowhere, you are currently being taxed where you live. So you can take these digital assets and these digital assets will be taxed where you are located, where the transaction is conducted. Now, this portion of cryptocurrency is very complicated, and I'll be conducting another webinar eventually about the particulars of how cryptocurrency is taxed in the United States, and I'll time that right before the filing deadline now in April. And finally, I believe, this is my own personal opinion, I have been heavily invested in crypto. It is an emerging technology. I missed out on the .com boom. I missed out on many other emerging technologies because I was a conservative investor, But after 2019, I saw the emerging adoptance, I saw the emerging trend, and I invested heavily in crypto, and it's paid out very well. And I don't see it going away anytime soon. And I see this almost as liberating as the internet, where you can conduct transactions immediately and with a low cost. So this opens up business for people who didn't have a shot before. The small guy, the little guy, someone without transgenerational wealth who's starting to pick up speed, and crypto just might be the answer to socio-economic mobility that the American dream no longer offers. I'm open for questions. I'll be checking the live chat right now, and feel free to comment. And I'm going to close this webinar briefly with the disclaimers. I am a licensed attorney at a state level in Puerto Rico. My RUA is 16,407, and this webinar is for informational purposes only. This is not legal advice. This is not financial advice. Conduct your own due diligence and conduct your own research before investing. And I am absolutely, positively not your lawyer right now, but if you want to hire my services, click on the link on the description below. And again, it's been a pleasure. My name is Christian Frank, and welcome to the Expat Expert. Thank you so much, and looking forward to the next webinar. Let me check the live chat to see if there are any comments.